Good evening, Bloke here, and I'm going to talk about 10 bonkers bargains. I didn't make the name up, but I waited for a video podcast something, and I thought, well, I'll just do my own. So I have. So let's get started. Right, helps if I share my screen. And let's start at the top and work our way through. Right. Bonkers bargains. What will we think of next? Right. So anyway, this is So this is looking at 10 different ideas. What's the use of shares analysis if you don't flag up bargains to people when the market throws a bit of a wobbler? Uh, so let's look at the 10 that I've come up with. Um, So the first one, and these aren't in any particular order, and it's not to say that anything that isn't in these 10 are inferior necessarily. I just kind of thought, based around, well, a couple of things really. I mean, obviously, there's a lot of macro uncertainty. We don't yet know how the Iran-US war is going to pan out, what that's going to sort of end up looking like. So I think you've got to kind of, I suppose, well, you haven't got to do anything. You make your own investment decisions. But I think my thinking on what I'm doing, so you can take of that what you will, is to just position myself so that if things turn out this way, it'll do all right. If they turn out the other way, it'll do all right. I'm trying to balance. Now, some of these ideas are clearly going to be more this and less that, but each of the 10 I feel are minimizing the well, I guess we could call it the war scenario and the peace scenario. Yeah, so we could have a prolonged war where just it causes a massive issue, massive world recession, depression, even. And then another scenario where it fizzles out and ends quite quickly. And there's a lot of pressure on well, both Iran and the US to end things. Like neither of them are in a position where a prolonged war is a terribly good outcome for them. So there's a lot of reasons and incentives to end things sooner rather than later. In the case of Trump, it's the elections, the midterm elections, and also just his obsession with his legacy. And in the case of Iran, it's more the economic survivability of effectively being cut off from income, and the economy wasn't strong to before the war began. So both sides have challenges. So there are reasons to think that it could end very quickly, and also overwhelming power of the US and advances in technology and advances in detection of enemy targets, that kind of thing. And maybe I'm over egging that, and of course none of us really know. And as someone said in a podcast earlier on today, like anyone who says with certainty is not, is talking out of something. So look, anyway, first idea is Pinewood. Now this fell out of the 250 FTSE 250 recently. It's delivered some weak results, but masked inside those weak results was the fact that they had bought Lithia out of the joint venture in the US, out of the US joint venture. So the buying it out sort of is effectively the same as what we saw when they bought or they divested themselves from their Pendragon previous owner that as soon as, well, not as soon, but after doing that, they were then able to secure deals with Pendragon's competitors. So thing, but in principle, could or shall happen in the US. Reasons I particularly like Pinewood. I mean, obviously, the endorsement from the Harwood gentleman is one reason. My own analysis as well is another. So I covered it in this article here. Pinewood win. So I sort of set out the reasons for that, and we can quickly sort of skip through those. So I mean, it's proper SaaS software. It's built from the ground up. It's got a very strong AI story and productivity story. And it's not AI as in let's just put in a load of buzzwords. It's AI as in let's deliver some chat functions, let's deliver some sort of knowledge-based functions that will actually be useful in the sale of cars. Because I know when you buy a car, I mean, I went to look at a car today for a member of my family. Not that I'm any great expert on car buying. Don't write in and ask for advice, because I'm good at kicking tires, and that's probably about. No, I do know a thing or two. But anyway, yeah, I mean, the amount of information you just work through when you buy a car is just ridiculous. And so if you've got a way to deliver that more efficiently through an AI agent, great, because I could see the reason that would work, and that would be a very useful sales tool. Because if you equip your buyers with information, you know what information they're asking for, so you know that they care about the color of the car or the MPG of the car or whatever it is. Anyway, I'm sorry. I sort of thought I'd do a very quick video on this, and I probably need to, because otherwise it will stretch out. We're at 7 minutes already. But yeah, look, I mean, when you look at the price earnings growth, it's 0.3. So essentially, that means it's growing fast. They've got an order book that is huge, and it's an order book. I mean, this is the thing that I just don't get, that the market doesn't get, that they've already sold like enough to propel themselves to much higher earnings. All they've got to do is deliver it. That's all they've got to do. And then if they can close further deals, then there's even more upside. So you know, without even using my own numbers, but just using the broker numbers, I mean, you can get to 13 times a price earnings of 13 times next year for the 2027 results. I mean, it's just the wrong price. Just the wrong price, and this, obviously different people come up with different opinions on what it should be worth or could be worth, but £2.57 is the wrong price, in my opinion. But you make your own investment decisions. Number two, I covered this on Mellow Monday, so some of you may have watched that or seen that, or um, and I went through a slide deck. I don't think I'm going to do that now because, well, actually, I will just very quickly. Hang on, let's grab it. So I should probably have prepared for these things a bit better, but yeah, here we go. Flight to quality. So essentially, limited supply smashing into huge increase of demand. There's a lot to like. State of the UK, state of UK purpose-built student accommodation, huge macro demand. And you kind of wouldn't necessarily know this or think this. I mean, I didn't know the number of 18-year-olds in the UK is actually growing quite fast. Like, I had no idea of any of that. So, impressive stuff. Limit of supply. I mean, yes, there is legacy supply still getting built and will continue to be built, but it's tailing away. And the next slide will sort of talk about that. The Renters' Rights Act will improve the prospects of PPSA, and then just the whole corporate pivot that they're doing. So, number of 18-year-old applicants in the UK is up 4.8%. Projections of international students are forecast to grow. Now, in my opinion, war in Iran is not going to affect, I don't think, the number of international students and the number of students generally. If anything, it could increase them, because if economic prospects are poorer, and I say this as somebody who was early 90s going into university, and it was, I can remember 1991 was a particularly harsh year, and I think, during university, I remember there being talk of green shoots of recovery. I'll always remember green shoots of recovery whilst at university. But yeah, part of my own decision and people I knew was that, well, unemployment is pretty high, interest rates are off the scales, you're better off getting an education. And so I think the same sort of calculus today. I know it's more expensive, but you've also got the school, the bank even of mum and dad, and then you've got loans and you've got grants and you've got different things, and people do it because they believe they'll earn more money by doing it, and statistically that is true. Anyway, I don't think we're going to see this, this supposed sort of collapse of number of people going to university. I, it, I find it very hard to believe, very hard to believe. And besides, the amount of, I suppose, restriction being introduced into other countries, particularly the US, under Trump, and that's not going to change for a couple of years, at least. Depends on what happens in 2028. But will the Democrats win in 28? I mean, you could imagine a world where maybe JD Vance is president number whatever 48. Anyway, Unite's strategy is to focus in on the Russell Group universities, so the high quality universities, the higher tariff universities. And you can see the number of applicants to those is growing, not shrinking. The number of students not living at home is growing, not shrinking. So it's all headed in the right direction. And it's not to say that 100% of Unite is to the high tariff. It's not. It's about 2/3, about 67%. And the other sort of big factor here is the just the net supply of beds. So the stuff below the line here is the number of retired beds. So about 10,000 are coming off. They're just sort of too old. The building's getting knocked down or whatever. And then these are the new ones adding in. So yes, there is sort of more supply than demand, but a lot of this more supply than demand is into very particular cities. So there's low tariff cities typically where those are being built. If you have a look at the weekly prices, I mean, weekly prices, like I was talking about this to somebody, like how much we used to pay back in the 90s for a student accommodation, and like how much it is today. I mean, that 230 to 270, I mean, that's about, what's that, 1100 a month? And somebody would say, oh yeah, well, how would anyone afford that? Well, they just do. I mean, if you live in London, like, you might be paying, what's that, 360, above 360. I mean, that is, what's that, 17, 1800 a month at least, more than 1800 a month. And these as well. So, this is the point at which building new PBSA is not viable. You've got to charge at least this much, at least 230 a week for it to be viable. So, it's not going to get built. It's as simple as that. And so existing providers of property, and Unite is a major provider of that, are going to be beneficiaries to that trend. Simple as that. And new supply will not come in. Now, there's also competition from houses of multiple occupations. So you can sort of share with your mates, and that particularly is on year 2, year 3. So two things to say about that. Number one, PBSA is excluded from the Renters' Rights Act. It kind of, there's a number of reasons why this is beneficial. I mean, number one is just the cost and cost of compliance, but also the fixed terms. So tenancies can't be granted more than 6 months in advance. Well, most students want to get their accommodation sorted out well ahead of of them going to university. So no more than 6 months would be like this month for people starting university in September. I mean, I can remember setting mine up the before Christmas, and most people did. I think you wouldn't want to leave it until less than 6 months before, but the new Renters' Rights Act forces you not to be able to take out a tenancy more than 6 months ahead. That you're not allowed to that you're allowed to sort of exit from it on 2 month terms. Again, that won't suit a lot of HMOs. So a lot of HMOs are exiting the market. That it's a challenge for them. Not for all, but certainly in the student part of the market, it's a challenge to comply with the Renters' Rights Act, but not so for the PBSA. So there's that. Unite itself has a strong, I mean, 6.8 implied yield, 7.8% dividend, with the price dropping a little bit more since I did Mellow Monday. It's now at 8% dividend, and that discount to the EPRA of 49% is now above 50. If you actually look at the post-period news, I estimated the share to be £10 23, the NAV to be £10 23. So the share price, which is now at £4 70, is like well above 50% discount. Now, there are a few short term issues because they acquired Empiric, which, by the way, has a lot of year two, year three accommodation. So, kind of like HMOs, small pods where you have eight or 10 people rather than a hall of residence that has 400 people across 10 floors or something. So it's kind of smaller units. But the problem is that there are some that are under occupied, and there's going to be a little bit of time, so because the academic year, of course, is September to July. We're already mid-flow for the 25-26 academic year. That ends in 4 months' time. And obviously, the ship has kind of half sailed for the 26-27 intake and academic year. So some of this stuff, might require you to be a bit patient, that it's not necessarily going to go back to, I mean, go back a couple of years and that occupancy was 99.8% full. Can it be again? Absolutely, it can be again, in my opinion. I mean, 95.2 obviously means that your profitability is a bit lower, but it's not tragic. It's, this is sort of, essentially you're buying 10 about £13 of property and £3 of debt. So it's, the NAV of £10 20 is pretty solid. I mean, it's not that it's got vast amounts of debt or vast amounts of sort of challenges. The debt is low, fairly low interest, 4.3 rising to about 4.7, I think it is, by 2028. They're targeting and exiting, disposing of property. When they're disposing of property, they're disposing of it at about 1% below the NAV. So you're buying it at 50% below you, but they're selling it at 1% below. Or, if you go back over several years, they were selling it at book value, not at a discount. And new accomos that they're adding on at sort of 7 or 8% yield, which is well above what the stuff they're disposing at sort of 4% yield. So they're getting rid of the rubbish stuff and taking on and developing good stuff. Disposals 300 to 400 million. They're doing buybacks as well. They've done I think something like about £50 million worth of buybacks so far. They've funded 100 million of buybacks. They're also developing further properties. The LTVs, as you can see there, 24%. That's quite low. Interest cover 6.2 times. 4.1 average debt. As I say, that's going to grow over the next couple of years, just because the cheaper debt is rolling off and new debt is more expensive. So yeah, structural scarcity, demand and supply, regulatory advantage, and then just it's an agile operator that's delivering success. I struggle to see why it's dropped to £4.72, other than I just think people are selling off things that they'll later regret selling off in my opinion. Um, anyway, that's the third one. Sorry, so that's the second one. The third one, bit of a wild one. This one is Ariana. Now, the reason I've included this was that I was gagged this week, not literally. Thankfully, I never have been gagged in my life. But anyway, metaphorically by the market abuse regulations, MAR. I thought, woo, that's a bit serious. Anyway, it was basically because somebody had messed up and sent out drill results without there being an RNS. So all the people of CHRY got a gag order. So it wasn't just me. I'm not anything special. But anyway, inevitably, when you get gagged on something, and by the way, I've been since ungagged. Well, curiosity sort of makes you think. Well, what was it that they were gagging you on? Like what was the secret? So let me share it with you because I can now because it has been RNS'd. Interestingly, it was RNS'd and the share price of Ariana, I don't think went up. Maybe it went up 0.1 pence, but it's gone up hardly at all. And I kind of looked at it. I was like, well, actually, that's really good news. Let me explain why. So currently their project in Zimbabwe. Now, obviously, you might have an opinion about Zimbabwe or whatever, but that's on you. Um, the current gold project that they are working towards getting to an FID has 1.52 grams per ton JORC resource. The drill results that they shared are significantly higher. So you've got some, 16.9, 7.7, high grade zones. So the fact that there are some high grade zones could improve the economics of this. It was also noticeable that they talk about oxide and oxide mineralization, which basically means they can just dig it out of the ground. It's and typically that means it's also found near surface because obviously it has to have been near surface for it to have oxidized. Yeah, makes sense. So anyway, it basically just means it's a lower cost to dig the stuff out. The visual geological indicators they talked of, and yeah, again, the fact that that they're talking about um, the visual geological indicators, to me that was a very positive little phrase. It wasn't sort of, I've put it in bold text. The RNS didn't do anything to explain this, but I sort of, my beady eye caught it, and I was like, huh. Obviously, if you can de-risk this a little bit, then obviously that is positive as well. The fact that it extends the envelope of the existing JORC resource potentially by 150 meters beyond the current resource envelope, and the current one is 1.1 million ounces. So if that is contiguous, I mean that could be substantial. Obviously, it's still early days and it's not nailed down. But I mean, even if you sort of said, well, 30% upgrade to the resource, obviously 150 meters relative that's just sort of a guesstimate based upon the distance more than anything else. But I mean, that gets you to something like at $40 per ounce, then Dockway alone is worth, well, I mean, would be worth £44 million. Now, um, the whole of Ariana's not worth or not priced at that much. I mean, you can sort of see it there. It's 54 million for the whole thing. So, essentially, Dockway would sort of almost sort of explain the entire market cap. But then you've got Turkey, Cyprus as well. You've got a producing gold mine in Turkey, and they own 23% of that. So, what valuation do you put on that? It just doesn't seem to, like, to me, the sum of the parts aren't adding up properly. So that's just, that was one that I thought it's a bit of a, and it hasn't really moved at all, despite the gold price moving. Obviously, gold is still 5,100 an ounce. Moving on to number 4, AVAP. This has got even cheaper. Um, and they've been buying back their shares like Billio, so they've reduced their shares now down to 61.65 million. I ran the numbers again because of the reduced number of shares. I mean, you're looking at a discount of 67.3%. Um, and I sort of thought I'd work through the numbers, just see what they look like. So you're getting £9.40 of aircraft, and this is based upon the fair value rather than the book value. So again, you might disagree with me and you can do your own numbers, but you know, based upon the fair value of those aircraft, plus then you've got £2.61 of cash, receivables, prepayments, restricted cash. It's basically like cash or cash like. You've then got the £1.22 of purchase rights and then tuppence of goodwill, minus then the debt, which is £9.16. But that's kind of where you're getting your £4.07, and you're paying £1.33 for it. I mean, it's sort of like, even if you sort of said, well, just throw the goodwill in the bin, like, in other words, you're talking about tangible assets. It it kind of it's I struggle to kind of work out why it's at such a discount. And obviously it's contracted income. I mean, and some of it is contracted income over years and years and years, and even the stuff that isn't over years and years and years. In fact, this is the 4.3 years is the average lease term. That when they get to the end of their lease term, that they're renewing it at higher levels, and some of these are there's a wide body A330. There's what, half of them are sort of narrow body 220s and 320s. Set obviously all based in Asia and Europe, with Click in South America. And there's no sort of concentration of customers, no concentration of different things. And I think that's the projected growth of the fleet. So by 2028, they're looking to have 39 aircraft. Everything's heading in the right direction pretty much, as far as it goes, and that's the debt profile. So they're all of these secured loans are amortizing, so those are amortizing down. Obviously, this term loan sort of gives them 5 years of breathing room until they need to renew that. There's your lease expiries. So you've got, I mean, the fact that there are lease expiries at the moment, when there's a very contested, there's a queue of people wanting to lease aircraft, that it's no bad thing that there are some that are renewing, because they're renewing then at higher rates. But yeah, as you can see, a large number. So this A330, for example, obviously that is only one aircraft, but that's the one that makes the most money. So that's kind of that was the one where they said, oh yes, we'd like to renew and extend our lease by I think it was a further 4 years. So took them from sort of here back over to here. Yeah. So anyway, there's yeah, lots to like about that one, I think. DC was the next one I picked. And I mean, that's a 10-year chart. And you kind of wouldn't really know that Iran and US are at war, and oil has gone up to over 100, and gas has gone up to, well, gas hasn't gone up by that much, to be fair, or US gas hasn't. European gas has. Obviously DC are selling LNG gas as part of their gas sales. Now, part of the reason this hasn't gone up will be, obviously they've got some quite high levels of um, options and sorry, the word's gone out of my head, but yeah, sort of, options on the sale. So they'll be making, selling at higher prices, but the offset will be the um, sort of my brain's not working properly, but yeah, they don't get the full upside of the higher prices of oil and gas because they've hedged. Sorry, that was the word I was gone out of my head for some weird reason. But yeah, because they hedge quite a lot of production. But noticeably in their latest results, they didn't disclose what level of hedging they're doing, which suggests to me that they're maybe de-emphasizing that because they've historically always made a big thing about, oh yeah, like this much percentage is hedged, and all of a sudden this time, for the first time in at least 5 years, that they've sort of just not mentioned it, which tells me that they're reducing it, I think. And as you get bigger and bigger, you don't need to have so much of your production hedged because you're bigger and bigger. Your level of risk is offset by your scale. That you can still generate cash even in a low or high rate, without having to resort to hedges. Anyway, yeah, I just think that one deserved to be in this list of bonkers bargains, um, because it hadn't gone up or hadn't appreciably gone up relative to its own past success. And when you look at this is sort of 2022. I mean, this is when gas and oil prices spiked before, wasn't it? And yet, there's really sort of no very muted reaction to DEC, which to my mind is an opportunity, because if you compare it against Ithaca or Serica, which are sort of two ideas in my 2025 and 2026 picks, DEC is noticeably cheaper now. HGEN is the sixth one I'm going to mention. So this one is delisting, and you can pick it up at, well, I said 4.3. I think buy price would be 4.5p, to be fair, and I think actually the market cap could be 6 million as a result of that. I mean, obviously, this has fallen a long way. It's fallen from grace. I mean, it was, what was it, a 105 pence NAV not so long ago. Now it's a 4.5 pence market cap per share. But what I would point out, I've been doing some calculations. I mean, they've sold, now these are my estimates, so I don't know that these are precisely the numbers, but they've sold a holding in Strom at a discount, and generated some cash. They're delisting, which obviously cuts down on the costs. But I mean, go back to this 6 million. Strom alone, sounds like a film, doesn't it? Strom alone more than covers that market cap. Now, yes, you might sort of have to sell the rest of it at the same level of discount, but you might not. But somebody wanted to buy Strom, so like even on the basis of Strom alone, 7.5 versus 6, like that covers the cost of that 4.5 pence share, as far as I'm concerned. So I think if you, personally, and it's just my opinion, but if you bought this, it's quite hard to think that this would not make some money. And it's not just Strom where I'm basing that on. Obviously, they've got cash on top. So, I mean, you've got, 1.5 plus potentially 7.5. So really, you'd only need this to make 4.5 out of 7.5 for you to break even. But what I would also point out is Sunfire. And if I compare it, because it is comparable to Ceres, CWR, FTSE 250 company, Ceres is up at £3. It's up 40% this year. Bloom Energy, similar company to Sunfire, is up 78% year to date, is profitable. You can go and look at Bloom's latest accounts, they're growing profits. Sunfire took a 200 megawatt order from Repsol, the Spanish oil energy major, I think, a couple of months ago, 2 months ago, I think it was. So there's a link to it. So that 23 million, I mean, could that be worth zero? I find that hard to believe as well, because you look at its peers, they're up, they're doing well. I mean, Sunfire's doing well. There's the news that they're doing well. They've secured a 200 megawatt order in Cartagena and Muquis, January, 2 months ago. Well, not even 2 months ago. So, um, yeah, I mean, hydrogen could be quite a beneficiary to the current situation with Iran, European gas prices going through the roof, etc. The economics of hydrogen haven't increased, or at least unless you are converting natural gas into hydrogen, I suppose they would increase. But I would also further point out that 23 million and all of these valuations, that 38.8 million NAV, you've got to realize what the new investment manager did. They whacked a weighted average discount rate of about 23% on this portfolio. They absolutely kitchen sinked out of it. Absolutely kitchen sinked it. Now, it was on a 13.7% discount, which itself is eye-wateringly high, but 23% is like ridiculously high. I mean, it basically means any income that you're forecasting more than about 4 or 5 years from now is pretty much worth zero. Like, you could be a billion, selling billions per year in 5 years' time as Sunfire. It's worth nothing in the model because it's being discounted by 23%. So I don't know. I mean, and these are my own estimates because they don't give proper disclosure in their December. They just give us the NAV in December, and then all I've done here is take the news flow of the sale to work out a kind of an estimate. But as I say, I mean, when you consider that discount rate and you consider the market cap, and then you sort of think, what are the chances of me at least getting my money back? I mean, the other thing you've got to put up with and tolerate is obviously if this is in an ISA, then it's going to be taken out of an ISA and put in a trading account, and and it will be unlisted, and unlisted companies can just sort of, you may or may not, like, the disclosures are different. They don't have to give you sort of a quarterly NAV. They don't have to give you anything really, apart from they've obviously got to still do their company's house compliance, which is once a year and about 9 or 10 months after the year end. Um, yeah, I mean, you kind of, I mean, the thing I would say is when you go back to like 15 months ago, this was worth 115 million. Okay. And you can see how much that weighted average discount has been absolutely chopped through it. Now, that one, to be fair, Bramble has gone bust, presumably is worth zero, is worth absolutely zero. But the rest of them, I mean, Sunfire has only, like, as far as I can tell, the only, on any of these really, the only reason that these numbers are lower than these numbers, so 66% has been stripped away, apart from this 11 million here, so 10% of it. So let's say 56 or 50 something has been stripped away, is because of a higher discount rate. Now, does that sort of mean that you will get 104 million? So if you did get 104 million on 6 million, I mean, that's a 15 bagger, 16 bagger. I don't think you'll get that, but I do think you'll get at least 6 back, and then there's a good chance that it'll be a lot higher, or at least there's a chance it'll be higher. I find it hard to believe that Sunfire particularly would just be worth zero. I find it hard to believe that Strom cannot be sold for at least at least that much. I mean, they basically sold it at a discount because they were desperate for cash, running out of cash. Now they've got cash. I mean, if they delist, they don't have what, 500,000 a year of costs of, maintaining the listing and whatever. That cuts down the costs by quite a bit. Yeah. So anyway, sorry, I don't want to sort of dwell on it too much, but the next one I'm going to sort of say is, well, look, even though airlines have been smashed badly by the news of the Iran war, I mean, this is just ridiculous. 25% discount to its NAV, where the NAV 205 Airbus aircraft, where 40% of them are the new Neo type, that when you look at the net asset value, like that, those aircraft, when you do a read across from Avation or from other companies that have similar aircraft, they're undervalued by at least a billion, probably more. But even if you just take the official NAV, it's undervalued now by about 25%. You can buy it. So basically, when you buy a pound of Easyjet, you're getting like £1.33 of aircraft net. That values their holiday business at zero. That values, the goodwill and the customer relations, all of that at zero. Like purely just the aircraft, you could make a profit on Easyjet, close it down, sell the aircraft, and you'd make a profit. So I just struggle with it being that price. I just think it's absolutely the wrong price. Now, will it recover tomorrow? Maybe not. But is this a bonkers bargain? Absolutely, in my opinion, it is. It's incredibly. Now, there's a couple of other things I'd say. 1.4 million British people went to Dubai. Now, I'm not counting people from Germany, Spain, like other countries, because EasyJet fly from other countries other than Britain. Just British people, 1.4 million fly to Dubai in 2025. How many people are going to fly to Dubai in 2026? Now, obviously, quite a few have flown out there and are there now and are getting evacuated back. But going forwards, long haul is going to be incredibly expensive. So if you want to go and fly to Brazil or something, like good luck to you, because you're going to spend like what, 2 grand, something like that, to get a ticket to go to, if you want to go to America, if you want to go to, I don't know, Australia, like it'll be horrifically expensive. Now, to my mind, yes, it'll be more expensive to fly to Spain or fly to Italy or fly somewhere, Mediterranean, but I think the demand for Mediterranean will go up and the demand for long haul will be the sufferer here. So EasyJet obviously is short haul. I think it will be a beneficiary to what's going on, to higher prices, to higher fuel prices. I don't think it'll be, and also because it runs a low cost model compared to Jet2, where the cost of sale per passenger is about a third more. I mean, it's a substantial difference because they, provide this excellent level of customer service and they've got like hordes of reps, crawling over the hotels and providing excellent levels of service. They never cancel flights. They just, even if they're keeping you waiting for 12 hours, we'll get you there. It's 4 in the morning. Don't worry, we'll get you there. EasyJet, flight's cancelled. Go on the next flight, or we'll refund you your holiday. Like they'll just cancel. It's just like bish bash bosh, low cost. But the customer satisfaction between EasyJet holidays and Jet2 is 83% versus 84.3%. It's 1.3% difference. So will people spend an awful lot more on Jet2 holidays, especially if the economy is heading down? I think Jet2 will suffer. I think EasyJet will be the beneficiary to Jet2 and to On the Beach and others. I think Jet2's model is a robust one, and it was interesting because I read the excellent weekly article from Cockney rebel, the chief rebel, and his similar sort of argument to mine, really. But Saga, and people that go on Saga holidays are on average 75 years old, and won't cancel the holiday because they maybe won't get to go on holiday again the following year because they're 75 and they may not see 76, which I thought was a bit morbid, but I can sort of see his point. But I don't think it's any different for somebody that's 30 or 40 or 50 or 60 years old. I really don't. I think everyone, like, would they give up their holidays? I don't think so. I think there's so many people that value, and there's a lot of evidence that it's not just me saying that. That's sort of consumer behavior. People will cut back on other things other than holidays. They might do fewer holidays. I accept that, but I just don't think that it will be as bad for EasyJet as the current share price indicates. I think. That's probably enough on that, but you get the idea that I think it's a bonkers bargain. This one is a bonkers bargain, in my opinion. I was about to say Chrysler. It's not Chrysler. It's Chrysalis. So Chrysalis, these guys have built and that's sort of a little screenshot of it. They've built sort of some basic, stuff around their bank account for businesses. Oh, um, and for consumers, but certainly for businesses. I mean, you can scan receipts, you can classify them, you can code them, you can basically do a load of clever things that you can't with other banks. Um, Now they say here, please note we can't provide access to third parties like accountants. Well, that's changing. So that's coming in the next couple of months. The people at Starling said that's in the roadmap and quite soon. They can integrate their platform with other software, so bank feeds and all of that good stuff. They've also got HMRC making tax digital for income tax. There's a lot of people getting caught up in that because Rachel's taxes from next month. If you come under, if you're a landlord or if you come under sort of the various categories of self-employment, you're going to have to start doing a quarterly return. How are you going to do a quarterly return? Well, you can do it through Starling Bank. They'll give it to you. I think it's a chargeable subscription, but it's quite a low cost one and just very easy to use. They released their CSAT scores. It's like seashells. Number 3 for service quality. Number 2 for online banking services. So very good results there. 4.7 on Trustpilot. Now, this is the bonkers bit. That's the NAV as at the end of December, 818 million. So the market cap back then was 534. So it was at a 35% discount back then. Today, and these are estimates, but I mean, I've looked at the Klarna share price. The Klarna share price has dropped. Okay, has dropped. Um, I I mean, I could talk about Klarna separately, but I do think Klarna will bounce back. I think Klarna is fundamentally a good platform. I think it's just this um, buy now, pay later overhang that people are worried about. But what you've got to realize is Klarna has been through all of that nonsense in the UK, and the UK introduced buy now, pay later restrictions and legislation. So they're probably better able to handle it than all of their competitors in the US who are new to it, who are new to those regulations that are not that are unused. So I think Klarna is going to bounce. But anyway, even if it doesn't, what you've got to realize is that you're buying Chrysalis at 422 million, 87p, 422 million. You're getting £1.58 NAV, so that's kind of dropped by 8p due to that. But this, you can see it here. I mean, like they've bought back 10 million shares, so it's about 2.5% of shares have been bought back in the, during the 2026. It's now at a 44.8% discount, but that's not the half of it. Basically, you're buying So Chrysalis own 11.6% of Starline, and that is valued at 436 million. Okay. So because Klarna and Wise are listed and they've got gross cash, take off the loan facility because they've paid down, you can sort of see it there, they've paid down 43 million of that. Basically, that gets you to 64 million quid of listed stuff. Take that off the 422, and you're paying a net 358 for something that's worth 436. In other words, you're getting that Starling for what? Like 15% discount? No, it's more. It's about 25% discount, isn't it? If you're paying 358 for 436, that's a substantial discount. And look at its valuation. Now, I've just taken the pro rata of the 11.6% to sort of say, well, a couple of years ago, it was worth less than a billion. Today, it's worth, or as at the end of December, it's worth 3.7 billion. It's probably going to IPO, well, maybe in 2026, probably in 2026. It's close to IPOing. And then you'll obviously, once it's listed, you'll know what it's worth because it'll have a share price. Same as Klarna now has a share price. Will it be higher than that? It could be. At the end of the day, when you actually look at its balance sheet from a year ago, because the next set of accounts are due soon, what you've got to realize is that they've sold a third. They've got a banking software business as well as their banking business. That sold a third deal into a Canadian company called Tangerine, which is one of the top 5 Canadian banks. The success story of its first 2 customers is very real. I noticed the Salt Bank, the one in Romania, has grown its customer base from 500,000 to 700,000 in the past couple of months. So lots and lots of good things. And then not only are you getting that 17.9% discount to Starline, but then you kind of go, well, hang on a minute, what about those other companies that they own? You get about 40p a share of Smart Pension, Deep Tech, Brand Tech, Deep Instinct, and Secret Escapes, the holiday company, all for free. 200 million quid's worth of stuff for free on top. You couldn't make this stuff up, could you? I don't think you could. That's why it's a bonkers bargain. Anyway, I'm going to speed up because I'm conscious I don't want to go over an hour. SEIT pay 493 million, and you're going to get 68 million of dividends. It's generating 148 million of free cash flow unlevered. It's delivering a 14% yield, dividend yield, covered 1.2 times, and it's at a 48.1% discount to NAV. Now, obviously, there's a lot of people sort of, oh, well, it's got a lot of debt. Well, it's got a lot of debt that it's amortizing. It's also got debt which are sort of debts that are going to run off as things grow. So I'm personally, because of the cash flow, like it's all about the cash flow. Like if it can generate enough cash flow, the debt is not a problem because it can just pay off the debt. Personally, would I like it to pay less dividend and pay off more debt? Probably yes, but it's it's paying a very chunky dividend, and it's paid me that for a good few years now, quite happily. This is what you get for your money. So now, first thing to say is that everything is discounted at 9.7%, which again is like far higher than NESF, the Next Energy people, far higher than UK Greencoat Wind. Like all of them are sort of at about 6 to 8, 9, but probably like 6 to 8% discount. This one's at 9.7, much higher discount. Same sort of assets, pretty much. This one focuses on energy efficiency rather than energy generation. some does some energy generation, but most of it is sort of energy efficiency. So let's um, let's find out ways to save you using and spending electricity, which sounds like a pretty cool thing when the price of energy is going up. Anyway, looking at their portfolio, so you're getting 1.17 billion of stuff that has that debt, and this is the debt at the top co, not the all the debt of the portfolio, but uh, minus the debt at the top co. So that's where the NAV of 950 million is coming from. So you can sort of see here, like if you take off the proportion of debt from each of these, like essentially you're getting sort of that much. So it's about 21% Red Rochester and so on. I mean, let's have a look at what's going on in these companies. So Red Rochester, new customers joined Red Rochester. The trend of electrification has driven the need for more than 25% growth in Red's electrical load and an emphasis on thermal growth. So they took on this new GE gas turbine. They bought a 1990 model and refurbished it and got it working. Fair play to them. Didn't buy brand new. But yeah, 25% customer growth post period. I would say that looks like upside. So that's the links there that it has that text in it. Seems quite positive to me. So that's this one here. That's 21% of the portfolio has just grown by 25% according to that article. I mean, I don't know that's independently true, and we don't know that from the company. But if it if it is as good as I think it is, I mean, like why are we worrying about the debt when cash generation is, increasing? Um, there's then other news. Nippon Steel bought US Steel, so that's a catalyst because they've announced for Indiana Harbor. They've confirmed, and again, it's that link there. They're moving ahead with a $3 billion growth plan for US Steel. A key part of that is restarting idled blast furnaces and investing in operational efficiency for primary energy. This is a major tailwind event. More steel translates to more revenue for primary energy, more cash to pay off debt. Onyx, not amazing news, but they sort of say here on their blog, now we've completed 400 projects and they've completed further projects post period. So there's a couple of upsides there, and I just think it's mispriced. I mean, we've been here before. If you go and look at the share price, it dropped down to sort of 40 something p and then bounced to 60, and there wasn't any sort of real reason for it other than it just got caught up in an air of negativity. So I think that's kind of what's happening again now. So um, as a counter cyclical idea, I think that's a good one. Final one is Trainline, and they did a trading update where they said the net ticket sales had grown. So there were people who were saying that competitors were going to chip away at Trainline, that its days were numbered. Well, clearly, when it's growing 7%, it's growing its revenue 2%, but it's growing its profits 13%. So, small amount of increased revenue is feeding through to the bottom line because of margins. Yeah, I think that's a positive result. I mean, the share dropped. I think it dropped and then bounced to. Let's have a look. Just pop this up onto the screen. Um, yeah, so you can sort of see it drop to like £1.80. It's now back at £2. But look, I mean, it's sort of still 10% down from a year. Sorry, from the start of the year. And if we go back in time, I don't know, 5 years. Um, back here it was what, £4. Back here it was £4. So I think it's still a bonkers bargain. A, because it's delivered results when clearly people were saying, oh, GBR is going to smash this, and it's gonna, the government are gonna sort of, it's not gonna. I mean, I've read the law, I've read the Railways Act, and read the commentary around the Railways Act, and it's quite clear that the the obligation is to provide fair and free competition, and there's an enforcement body that can take enforcement action called the Office of Rail and Roads, I think it is, ORR. So, to my mind, I think this fear of whatever is just based upon people not understanding and not looking at the detail closely enough. That it seems to me that um, when it's delivering double-digit growth, international consumer 12% growth, and in I think it was Southeast France, the growth was 26% growth, and the growth of the API usage was 58% growth. And the API usage was the thing that caught my eye particularly because that's the one there, they could sort of federate this across, you know, uh, travel companies and different to grow profits. So yeah, I'm pretty relaxed about Trainline and think it's very cheap still, even though it's bounced by about 10% on the news that its results were far stronger than people were sort of saying that they could be. But and also I just point out the amount of buybacks they're doing is just phenomenal as well. The buybacks, they've bought back 21% of their shares. They've bought back 21% of their shares since they started trading. But yeah, the number of buybacks is substantial, and obviously that just increases the NAV of the company. So buying it at a discount essentially. So I think that's everything really. So yeah, just thank you for watching and hope that's been useful. If you want to give it a thumbs up and a like and a subscribe and all of that good stuff, I'd really appreciate that. And if you want to share it and so on, then please feel free to tell people about it. And if you want to comment on which is your favorite of the Bonkers bargains, do feel free to comment or to add what you think are the best of the Bonkers bargains. If there's any that you think are just complete garbage, I mean, I'm not saying I've got a monopoly on good ideas at all. I mean, I think that as I say, I mean, there's others as well that I could have made this longer than 10 really, but I think I think the 10 are pretty solid. And I mean, the other final thing to say quickly is hopefully that they are all sort of ones where it, the war could play out either way and they'd still be beneficiaries. The train line, I mean, people are still going to travel by train. That's not really going to change. The SEIT, the energy efficiency, I mean, that is a sort of another sort of way to play the fact that oil prices have gone up. So the Chrysalis, I mean, it's just not particularly connected to the war particularly at all, but just is stupidly cheap for no particularly good reason. Easyjet could be sort of weirdly a beneficiary to the war, even though oil prices and jet fuel prices are higher, that it actually might be a positive, not a negative overall. HGEN, which is just, again, it could be a beneficiary to to the conflict. DEC certainly would be a beneficiary to the conflict. AVAP, again, you know, sort of not an obvious one really, but these aircraft are in long-term contracts, and the the reason that this would get unstuck is if a load of airlines started going bust, but we're very far away from that being the case. Um, so yeah, to my mind, the level of discount built into this is just far higher than than the reality. And then the Ariana, again, not really connected in, but independently of value, Unite, yeah, not really connected in. So it's a sort of divorced from the realities of war. And Pinewood again, just sort of mispriced. So that's sort of the reason that those 10 are in there, and why I've picked them. And just to say thank you again, and cheerio for now, cheerio.